Hey everybody, thanks so much for joining. I see people are coming in to join the webinar right now. Thank you so much for joining us. We're going to get started in about 2 minutes. We're going to give people a chance to get into the room. We should have a big group with us today, so we want to give everyone a chance to log on, get everything hooked up and connected properly. But for those of you who have already popped into the room, I would love to hear from you in the chat what type of business you have and where you are zooming in from. And I'm just going to repeat myself a few times because I know people are continuing to come into the webinar. So we're going to get started in about 2 minutes. But for those of you who are already here, I would love to hear from you in the chat of what type of business you have and where you are zooming in from. Okay, we are live streaming as well. So if you're watching live, hello, it's great to see you. And we're going to get started in about 1 minute. We have a lot of content to cover. So I want to be sure that we have plenty of time for the content and the Q&A. And if you are just joining us, I'm just repeating myself over and over again. I'd love to hear from you in the chat where you are zooming in from and what type of business you have. We're going to get started in about 1 minute. I always start 2 minutes after the hour, so probably about 30 more seconds, and then we're going to jump into the content. All right. Well, it is time to get started. Oh, I see some folks in the chat. So KW says tuning in from Atlanta. Renat says real estate in Florida. Jennifer from Boise, Idaho, financial services. Jolanta from Massachusetts. I'm planning to do real estate. Awesome. So we have a couple real estate peeps in the house. That's great. Michelle is from California. I'm going to go ahead and switch over to my slides. Oops. I can tell my mouse is going to be sticky today. All right, so welcome to LLC versus S Corp. Which one is right for you? With me, Andy Smiles. I am the director of content here at Collective. And before we talk a bit about Collective, I want to go over really briefly what we're going to cover today. So we're going to talk about self-employed taxes 101. We're going to do talk about LLC and S Corp basics. Then we're going to get into the differences between LLC and S Corps. We're going to talk about how to choose the right structure for you, and then we're going to talk a bit more about how to get started. And then at the end, we'll have a live Q&A. So a housekeeping thing on the live Q&A is if you can please put your questions in the Q&A box and not the chat. So I'm going to repeat that. Please put your questions in the Q&A box and not the chat. I love answering questions. I'm committed to answering all the questions in the Q&A box, but unfortunately, the chat is very hard to monitor and keep track of which questions have been answered. The Q&A box is wonderful because I can just go and click through and notate the ones that I've already answered. You will have a better chance of having your question answered if it is in the Q&A box. Another fun thing I'll mention is that you're going to see a lot of really wonderful people in our slide deck today, and these are all Collective members. Okay, so here is a brief note from our legal team. This webinar is for educational purposes only. Nothing contained in this or any other related webinar should be viewed as legal or tax advice, and always consider consulting a professional if you need legal or tax advice in operating your freelance business. So earlier I said my name is Andy, and I'm the director of content here at Collective, but what is Collective? Well, Collective is the first all-in-one online financial platform designed for self-employed people. So I know that's a lot of words. They're very big on the screen. So let's kind of break that down a little bit about what do we mean when we say all-in-one financial platform. This is your money when you are self-employed. Basically, there's a lot of stuff that you need to keep track of as a self-employed individual. Everything from your bookkeeping to setting up your business, which is why you're here today, to doing your taxes, ongoing compliance, and thinking about even retirement. And things get even more overwhelming when you need to make a financial decision or during times like tax time, because what you realize is that all of these things actually impact each other. So your bookkeeping is going to impact your taxes. Your estimated taxes are going to impact your taxes and financial reports. Your business setup will impact how much compliance you have, so on and so forth. It can be very overwhelming, and this is often where people start to feel like things are slipping through the cracks. So when we say Collective is an all-in-one financial platform designed for self-employed people, what we mean is we bring all of these disparate parts of your business finances under one platform with a team of experts there supporting you every step of the way. We're going to talk a bit more about Collective, but I want to jump into the content because I know that you're here to learn about LLCs and S Corps. I'm going to start with a poll. So Sarah, who's helping me today, is going to run this poll. And we want to hear from you and get to know you all a little bit better. What are you struggling with most right now? Okay, so is it setting up your LLC or S Corp? Is it doing your taxes and bookkeeping? Is it finding ongoing financial advice? Or is it retirements and benefits planning? So I'm going to give everybody about 20 seconds to complete the poll because I think you probably know what you're struggling with most right now. And you may not really need to like think deeply about it. You're probably here for a reason. So I'm going to take a sip of tea and then we'll close it out. All right, let's close out the poll. All right, so 60% of you are struggling with setting up your LLC or S Corp. You're definitely in the right place. You're going to get so much information on this today. 36% on taxes. We're going to talk a little bit more about taxes today as well, and hopefully you'll walk away with some information that will help you. 20% with bookkeeping. Oh, Collective is going to be able to help you with that big time. 8% with finding ongoing financial advice, and 20% with retirements and benefits planning. The good news is for everybody who voted in the poll today, we're going to touch on each of these topics. And at the end, we'll talk about how Collective can help you with each and every one of those things. But for now, let's talk about a topic that I'm sure you all are just so excited to hear about, which is self-employed federal tax basics. So when you are self-employed, there are two types of taxes that you pay. And the first type is income tax. Now, income tax is what people generally think of when they think of taxes or April 15th. So right now we are in tax season and you are probably thinking a lot about your income taxes. In the United States, individuals pay between 0 and 37%. This is based on your tax bracket. Now, depending on what tax bracket you are going to pay a different amount in your income tax. But one thing that really stresses people out about their tax bracket is they think that their tax bracket is a flat rate of the tax that they pay. So for example, you may hear that you're in the 24% tax bracket and you might be thinking, oh my gosh, I have to pay 24% in taxes on all of my income. And that is actually not how income tax works or how the US tax system works. So the United States has what's called a progressive tax system. And this means all your chunks of money that you earn are taxed in tiers that progress up. So for example, the first chunk of money you earn is taxed at 10%. The next chunk of money you earned is taxed at, let's say 15, let's say 20, the next chunk at 22, and that last final chunk is taxed at 24%. So your tax bracket is not actually the amount that you pay on all of the money you earn. It's actually where you cap out with how much you're going to pay in tax, what percentage you're going to pay in tax. The percentage that you actually pay is an average of all of those different tiers and different step ladders up of tax that you pay. So if you're in a higher tax bracket, like a 37%, for example, or 35%, don't get too stressed out because you're not paying all of that on your income. It is going to tier or progress up. Now, the next tax that you pay is self-employment tax. Now, self-employment tax is different from income tax in two ways. First, self-employment tax is only for self-employed people. I think that's pretty obvious in the name. But second, self-employment tax is a flat rate. So I just went on this whole explanation about income tax and how don't get stressed out if you hear you're in a high tax bracket because you're not paying that as a flat rate. It's progressing up. With self-employment tax, it actually is a flat rate. It is 15.3%. And self-employment tax pays into your Social Security and Medicare. So that's what's making up that 15.3%. Now, when you are self-employed or an employee, you are both paying into your Social Security and Medicare. But when you're an employee, things work slightly differently. namely that half of the Social Security and Medicare taxes are paid by your employer. So this means if you're an employee, you're only on the hook for half of the Social Security and Medicare taxes. The other half is taken care of by your employer. But when you're self-employed, the word self is in there and you are on the hook for the whole 15.3%. You're going to pay both halves of this tax, which is why if you have come from an employee job and you now are self-employed and you're like, wow, it feels like my taxes have doubled. When it comes to Social Security and Medicare taxes, they have. Now, I want to demonstrate this another way because percentages sometimes are not the easiest thing for people to understand. So let's look at why self-employment taxes are so expensive. So here's an example of somebody who owes $15,000 in Social Security and Medicare taxes. As an employee, this person is only personally responsible for $7,500 of it, right? Because the employer is going to pick up the other half. But when you're self-employed, in this case, this person would be responsible for the entire $15,000. And that is why being self-employed and your taxes can often feel so expensive. Okay, so now we know what types of taxes you pay as a self-employed person. Let's look at how you're actually taxed. So this tax structure is for sole proprietors and single member LLCs. So we have our revenue at the top, and then we have our tax deductions. Revenue is just the money you earn before tax deductions or expenses and paying your taxes. I always used to call it like pure undiluted money that you earn from selling your goods and services. It's just what comes in from selling whatever you do. So you have your revenue, and then we subtract our tax deductions, which are also known as our business expenses. What's left when we subtract our deductions from our revenue is what's called net income. And if this net income is a positive number, it's called profit, and it means that you made more money than you spent. If it is a negative number, it is called a loss, and it means that you spent more money than you made. Now, when you are self-employed, regardless of if you have a profit or a loss, this profit or loss is going to pass or flow through to your owner tax return. In other words, the profit and loss is being passed through to your personal tax return. And then on your business profits, that self-employment profit, you're going to pay self-employment tax, that 15.3%. And then you have income tax. Now, income tax is like not as straightforward as self-employment tax. So you're going to pay income tax on your business profits, right? Because these have flowed or passed through to your personal tax return, plus any other income you have in your life. So if your business is a side hustle and you have a regular like employee job, you're going to combine those incomes. Or maybe your business is your main hustle, but you are filing jointly with somebody. You are going to combine your incomes. Then you are going to subtract your personal adjustments and then subtract the standard deduction or itemized deduction, depending how you take it. What's left after all of this math is your taxable personal income. That is what income tax is assessed on. So I'm not showing this to you so you can go figure out your own income tax. It is somewhat complicated. It's more just to show you that everyone's tax situation can be very, very unique based on a lot of personal factors and nuance in the things that are happening in their life. So it's very difficult often for people to give you blanket tax advice, especially when it comes to income tax, because there are so many factors that will impact how much you pay in income tax. The other key takeaway of this slide is that you pay both of these taxes. You pay income tax plus self-employment tax. So your tax bill is the combination of these two taxes. Okay, so why does this stuff matter? So you came here today to learn about LLCs and S Corps, and I just spent 10 minutes talking to you about self-employed taxes. This stuff matters because how your tax differs if you're an LLC or an S Corp. And that's what we're going to get into next. So let's start with the LLC. What is an LLC? Before we can really talk about the LLC, we need to talk about the concept of legal structures. So, legal structures are formed in a state with the Secretary of State. So, an LLC and a corporation are both types of legal structures. And when you form a legal structure, what's happening is you're required to go through a formal organization process with the state, and usually that's with your Secretary of State. Now, legal structures are formed at the state level. So every state is going to have a different process for how you form your legal structure. So if you're thinking about forming an LLC in California, or you're somebody who lives in Maine, the process for how you form your LLC will differ based on your state's regulations. Now, when you have a legal structure like an LLC or a corporation, you are often required to file an annual report with the state, letting the state know who manages the entity, and sometimes even will pay an annual or biennial fee. Again, this is all contingent on what your state's rules are, but often states require you to file this paperwork. So, kind of the high level takeaway here is that to form a legal structure like an LLC, one, you need to go through a formal organization process with your state. And two, you're introducing more paperwork and compliance regulations into your life. Now, you might be thinking, but what if I don't have a legal structure? Like I've never gone through that process with my state. What does that mean for me? If you don't have a legal structure like an LLC, if you haven't gone through a formal organizational process, you're what's called a sole proprietor. And there's nothing you need to do. If you have self-employed earnings, you're automatically a sole proprietor. So, as a sole proprietor, you and your business are one. So, this means that under the eyes of the law, and we're really talking about the way the law treats your business, there is no separation between your business and your personal assets. They are all considered one. Even if you have them in different bank accounts, because we're talking about legally how your business is viewed, they are all considered one and the same. And as a sole proprietor, your business profits are going to pass through to you, the individual. So that chart of how you're taxed that I showed you earlier, that is how you're taxed as a sole proprietor. Now, the nice thing about being a sole proprietor is that you don't need to file an annual return with your state. So there's a little bit less paperwork that you're required to do. Okay, so that's a sole proprietor. Now let's talk about being an LLC. So we've already really touched on this, but the first thing about being an LLC that you need to know is that it requires registration with your state. It's going to have that ongoing reporting and sometimes those state fees, right? We talked about this. There's more paperwork that's involved with having an LLC. Next, we have limited liability protection. So as an LLC, you are forming a legal shield between you, the personal you, and your business. This is actually one of the primary benefits for why people form LLCs. It's for that liability protection. So what this means is that earlier I said when you're a sole proprietor, you and your business are considered one. When you are an LLC, you and your business are considered separate. And your business assets and your personal assets have a legal shield between them. This means that your personal assets are safe in most cases if your business is sued or you have creditors. So in that event, they cannot break that legal shield protecting your personal assets. Personal assets are things like your personal checking, personal savings, your house, your car, right? All of these things, your retirement accounts, all of these things that are personally owned by you and not the business. Now, a lot of people form LLCs because of the liability protection, and it's attractive to them to have that separation. But there are other reasons to start an LLC. Like it can lend credibility to your business. So prior to working at Collective, I was a business financial consultant for about 11 years, and I had quite a few clients who started to form LLCs so they could open up contracts with larger companies. So I'm talking about companies that if I said their name, you would know them immediately. A lot of times those larger clients, they want to contract with a business entity versus an individual, or they're required to. So in my time as a consultant, I saw many of my clients form LLCs in order to open up to being able to contract with these larger companies. The other benefit of the LLC is that it allows for multiple members, or what are called owners. So in LLC speak, a member is basically an owner. So when you are a sole proprietor, we have the word sole in there, right? Which means you are the only one that can own your business. But when you are an LLC, you can have multiple owners of that LLC. There we go. And then finally, when you are an LLC, those business profits are going to pass through to you, the owner, right? So it's still going to pass those the business profits on to you, the owner. And this is a good thing. We haven't really talked about this yet, but we like what's called pass-through taxation, because what it helps us do is avoid double taxation. So when someone is taxed as a C Corp, the corporate entity pays taxes at the business level and the owners pay tax at the personal level. When you are an LLC or a sole proprietor, the pass-through tax structure means that you only pay tax one time versus twice in the C Corp tax structure, where the business is paying taxes and the owners are paying taxes. You've probably heard about this as double taxation. So the benefit of the LLC is that you're still getting that pass-through tax structure. Now, here is a very, very important thing to know that a lot of people don't know, which is that an LLC is taxed the exact same way as a sole proprietorship. I see this mistake a lot, where people will start an LLC and they'll think, great, this is going to impact my tax bill. It's going to make my taxes lower. I'm so excited. And then the next tax season rolls around and nothing changes. So LLC is taxed exactly the same way as a sole proprietorship, which means that flow chart I showed you earlier is how you are taxed as an LLC, a single member LLC as well. But you can ask the IRS to change your tax treatment as an LLC. We're going to talk about that in a minute. But first, I just want to do an overview of the differences between a sole proprietor and an LLC. So an LLC requires registration with your state, where a sole proprietor doesn't. And that LLC is going to create that legal shield between your business and your personal assets. Remember, as a sole proprietorship, you do not have that liability protection. And the LLC can have multiple owners, where a sole proprietor cannot. Now, with both the sole proprietor and the LLC, those business profits are going to pass through to the owner. So the business does not pay taxes at the business level. And then you, the owner, will pay self-employment tax on the profits. Now, there's one more thing that I kind of mentioned earlier about the LLC, which is that it can change the way it's taxed. So the LLC has what we call tax flexibility. And that is going to bring us to what is an S Corp. An S Corp, very fun fact, is a tax election for your legal structure. An S Corp is not a legal structure. I know that the way that we talk about them as their own standalone structure. So we'll say stuff like, oh, I'm going to become an S Corp. I'm going to form an S Corp. I am an S Corp. Even this webinar, LLC versus S Corp, right? We are talking about them as these two separate entities. But really what's happening with the S Corp, it is a tax election for your LLC. So if we were going to be technically correct about the name of this webinar, it would be LLC taxed as a sole proprietorship versus LLC taxed as an S Corp. Now, none of you would come to a webinar called that, because you'd be like, what is happening? I don't even know. Thank you. That is way too technical. So we call it LLC versus S Corp. But that is technically what we're talking about here. When you are an S Corp, you are still an LLC. You are just layering a new way of being taxed on top of your LLC. Another way to think about it is like building a house. When you build a house, the first thing you do is you lay the foundation. The LLC is that foundation. And then what you build on top of that is going to be your tax strategy. That is the S Corp. So S Corp is a tax election that you are electing for your existing legal structure, like the LLC. So why would we want our LLC to be taxed as an S Corp? Well, the primary reason is that S Corp owners don't pay self-employment tax on their business profits. So being taxed as an S Corp eliminates self-employment tax from your life. Basically, what's going to happen is that being an S Corp, having an S Corp tax structure, creates an employee-employer relationship between you and your entity. So start thinking about yourself split into two. And your entity is required to hire you, the personal you as an employee, and pay you what's called a reasonable compensation through payroll. Basically, you're getting a salary from your business that you are running through payroll. You become an owner employee. Your owner employee wage is subject to payroll tax. It's at 15.3% because remember earlier I said that employees are paying Medicare and Social Security taxes as well. So it's the same amount as self-employment tax. But half of the payroll taxes are going to be withheld from your paycheck like any other employee situation. And the other half are an expense for the S Corp because the S Corp is your employer. And this is like any other employee-employer relationship. The employer is going to pick up half of those payroll taxes, Social Security and Medicare taxes. That is your S Corp. Now, your S Corp profits and your employee wages become part of your personal income because remember, LLC and S Corp, they're both pass-through entities. So the profits are still passing through, which is good. We like that. This is a good thing. We don't want to pay taxes at the corporate level. So we like that. And then this is what you'll pay income tax on. This is a lot of words on the screen. Let's look at this. So I'm not going to go back over this. This is just a quick refresher of how you're taxed as a sole proprietor and LLC. It's just to kind of refresh your memory because I know this is a lot of new concepts for a lot of you. Now, let's talk about S Corp taxation. Here at the top, we have our S Corp revenue. Remember, this is the money that you make before expenses and before having to pay any taxes. Now, we have our operating expenses and we have our salary, because our owner's salary becomes a tax deductible expense of the business. And then here on our salary, we're going to pay those payroll taxes, that 15.3% that pays into our Social Security and our Medicare. Now, when we take our S Corp revenue and we subtract our expenses, we subtract our salary, we subtract half of that payroll tax, what we get is our S Corp profit or loss. And then that profit or loss is going to pass or flow through to the owner tax return. And you're also going to report your W-2 salary, so that salary that you earn from your business on your tax return as well, because that's income that you're also earning. So you are now reporting the pass-through profits and your salary. And that is what you will pay income tax on. So what's cool about this slide is where once there were two tax boxes at the bottom, there is one. But you're probably looking at this and you're like, how does this help me save money? Let's look at it. So here's an example of somebody who is earning $160,000 in profit. Now, if they are a sole proprietor or a single member LLC, not with the S Corp tax election, then all of that profit, that $160,000, is subject to self-employment tax. It's Social Security and Medicare taxes at 15.3%. Now, if they are the S Corp or an LLC electing to be taxed as an S Corp, then their profit is $160,000, but their owner is going to pay themselves $60,000 as their reasonable salary. Well, what's subject to those Social Security and Medicare taxes? That 15.3%. It's only that $60,000. So this now becomes a simple mathematical exercise where with less money subject to that tax, that 15.3% tax, you pay less taxes. So in this example, the tax difference is $15,000. Now, people really like this slide because of the $15,000 thing, but what I want to talk about are the last two lines because I actually find those lines really interesting. So the pass-through profit. What is passing on to the owner? Well, for the sole proprietor, single member LLC, it's all of it, everything, the $160,000. And that becomes their total taxable personal income. But for the S Corp, it's $100,000. Why? Because the S Corp is going to write off the owner wage, that second row, that $60,000, which will lower the overall profits of the business. But the owner is still earning that money, right? That money is still being paid out to you. So the taxable personal income is the same. Basically, TLDR, you're saving money on taxes and earning about the same amount personally. Okay, so a lot of people at this point are starting to be like, I get it. So how much I pay myself really is going to impact my tax bill. So how much do I pay myself, and can I just not pay myself anything to avoid all of these taxes? So let's talk about it. So you have probably noticed that I keep using this term reasonable compensation. This is what the IRS says. And unfortunately, there is no set standard for reasonable compensation. The IRS says it is a facts and circumstances argument. This means you cannot go to the IRS website and type in marketing consultant in California S Corp salary. There's nothing there. You really have to understand the facts and circumstances of your business, your location, what you do, your industry, how much your business is earning to set a compensation that is reasonable. This is why it's very important to work with somebody like Collective or a tax professional to help you figure out your reasonable salary, because your salary is a tax strategy. It is not about how much you want to get paid from your business. It's not what's on your vision board about what would be so cool for your business to pay you. It is not even what you need to live off of personally in your budget. There are other ways to get money out of your business that we'll talk about in a minute. What this really is about is tax strategy and being in compliance with the IRS. So you'll notice here with this little graphic, which I love, if you were to slide this graphic, this little slider all the way up to the top and pay yourself all of your expected profit, well, you would have incredible defensibility from the IRS, but you would have no tax savings because you would be replicating the tax structure of a sole proprietorship. Now, if you were to slide the slider all the way down to zero and pay yourself nothing, well, you'd have incredible tax savings, but no defensibility to the IRS. So it's really about leveraging the S Corp tax structure appropriately while remaining within compliance with the IRS. Okay, so I just said something really scary, which was that your salary from your business has nothing to do with how much you actually need to live off of, right? I was like, forget that. Forget your personal budget. You're choosing your salary based on the tax strategy. So you're probably thinking like, great, so I become an S Corp and I just like have nothing to live off of? No, there are different ways to get money out of your S Corp. So we have your business income and we have operating expenses. One way is the salary, the payroll. We've talked at length about this. The next way that you'll get money out of your S Corp is through distributions. This is a transfer from your S Corp to your personal account. So I used to be an S Corp business when I was self-employed. And this is what I did. On the first of every month, I had direct deposit, my payroll from my business. And then I also had a distribution on the same day. And basically what that distribution's job was to do was to make up the difference between my salary and what I actually needed to live off of. So if I needed this much to live off of, my salary was here. The distribution that I had going out automatically every month filled in that gap. And that's how you can use the salary as a tax strategy, but still be able to, like live your life. The final way to get money out of your S Corp is through these reimbursed expenses, which we're going to get a little bit deeper in next. But basically, the S Corp can reimburse you with cash on certain personal expenses that you pay. So there are some additional benefits to S Corps. A lot of people are focused on S Corps because of the tax saving nature of it. But there are other things that are really great about S Corps that don't have to do necessarily with tax savings on the self-employment tax. So first of all, S Corps just have more deductions available to them. And what that does is that lowers the profits and that helps you save on all of your taxes. Now, S Corps also have higher retirement contribution limits. So when you're an S Corp, you can start what's called a solo 401k. And with a solo 401k, you can contribute to your retirement account as an employee and as an employer. The employer contributions become a tax deductible expense of your business. That kind of ties back to number one. And then, of course, the employee contributions are treated like any other 401k contribution, that they're pre-tax. Now, that's all really cool, right? Like already we're talking about some really cool things, but there's a whole other aspect of this, which is that the employer contributions and employee contributions each have their own contribution limits. And when you combine those contribution limits, they're often higher than other retirement accounts, which means it can enable you to catch up on your retirement savings faster. I cannot tell you how many S Corp owners tell me that this is actually the thing that they like the best. It's not something that gets talked about very often because it's a little bit more like nuance to the S Corp, but it is a benefit if you are thinking about trying to catch up on retirement savings. Finally, there's something called the accountable plan, which I alluded to in the last slide. Basically, an accountable plan is an agreement between an employer and an employee that the employer will reimburse the employee for personal expenses. So your S Corp can reimburse you for things like your home office expenses, mileage and the use of your personal vehicles, your home internet, and the use of your personal cell phone, among other expenses. So if you're somebody who's already enjoying the home office deduction and you're worried that that's going to go away, it's not going to go away. It just, the way it works changes. So instead of it being a deduction you take at the end of the year on your taxes, what's actually going to happen is every month you submit your expenses to your S Corp and your S Corp sends you cash for those expenses. Now, that's a reimbursement. It's not tax because it's a reimbursement, not a fringe benefit. The S Corp is taking that reimbursement as a deduction on the taxes. That becomes a tax deduction of the S Corp as well. Ooh, something's ringing. Okay, so let's talk about the differences between an LLC and an S Corp. So an LLC and an S Corp is still an LLC. So this is really should be framed as the differences between an LLC that isn't filing the S Corp tax election versus an LLC that is taxed as an S Corp. But both LLC and S Corp, you get that legal shield between your business and personal assets because as an S Corp, you are still an LLC, which means you still get to enjoy all of the benefits of the LLC and that liability protection. Now, LLC and S Corp are both pass-through tax structures, which means your profits are being passed through to you, no double taxation. Remember, we like that. When you're taxed as a LLC in the default tax way, you will pay self-employment tax on your profits. If your LLC is taxed as an S Corp, you will not pay self-employment tax on your profits. We still got income tax with both of them. So you're still going to have to contend with income tax. Unfortunately, that's not one that we can make go away. Now, only as an S Corp can you pay yourself your employee wage. But both LLCs without the S Corp tax election and with the S Corp tax election can pay themselves through draws or distributions. In LLC world, it's called a draw. In S Corp world, it's called a distribution because nothing can be simple in accounting, but it's the same idea. You're transferring money from your business account to your personal account. Now, there's one last thing that we haven't talked a lot about, which is that as an S Corp or having your LLC taxed as an S Corp, you will have to file, your business will have to file an informational tax return in addition to your personal tax return. All right, the moment you have all been waiting for, which one is best for me? How do I know which one I should do? So an LLC without the S Corp tax election is best for those who are first new businesses with very little earnings. If you're just getting started and you haven't started making a profit yet, maybe you're just investing in your business a lot, or you're still taking a loss, it's not really worth it to switch to S Corp taxation right now. Really, the guideline that we use internally at Collective is if you are earning less than $60,000 in profit per year, the S Corp tax selection probably isn't a good fit for you. Now, why is that? Because with S Corp tax status, you are going to have additional tax and accounting complexity. We already talked about one of those things, which has to do, well, we talked about two of them. Payroll, you have to run payroll now, and you also have another tax return you need to file. That means that there are additional costs associated with this tax and accounting complexity. Often what we see is until you're at the $60,000 in profit per year, the additional cost of running your S Corp eats up the tax savings. So it's not really worth it, and it just creates more work for you. So if you are earning less than $60,000 in self-employed profit in a year, remember this is profit, so this is after expenses, then you may want to just stick with the LLC until you're ready to introduce that complexity and that tax savings. Finally, LLC is best for those who just want a simple, straightforward tax structure. If you just listened to this webinar and you're like, I don't want to do any of that stuff, more tax returns, payroll, are you kidding me? That's a lot of work. Then you probably don't, the S Corp may not be the best fit for you. S Corp is good for those who want to maximize their retirement savings. This is something people don't really think about a lot, but it is something that as you get older, you start to think about more. It's also good for those who are earning more than $60,000 in profit per year. This is the place where you will start to feel the tax savings effects of the S Corp. And then for those who have enough cash flow to make regular payroll runs. So this confuses people a lot. They're often like, oh my gosh, does that mean I have to set my salary on January 1st and stick to that? No. Your salary can be in flux depending on if your income fluctuates. But what you don't want to have happen is that you don't pay yourself via payroll at all throughout the year. And then come November, you're on the hook for a $60,000 or $70,000 payroll to be in compliance, and you don't have the cash on hand to make that. That is what we mean by cash flow to make regular payroll runs. You want to be sure that you can keep up with that requirement, because it is a requirement from the IRS. Okay, so let's talk about how to start and operate your S Corp. So how do you get one of these things going? Well, we're going to start with the setup. The very first thing you need to do is have an LLC. So if you do not have an LLC and you're a sole proprietor, you must create one. A sole proprietor cannot ask to be taxed as an S Corp. So that's going to look like filing articles of organization with your Secretary of State, and then filing any other state required paperwork, as well as setting up your LLC operating agreement. Next, you are going to make the S election, which basically means you're going to ask the IRS to tax your S Corp or tax your LLC as an S Corp. The first step is that you need to get an employer identification number from the IRS. Then you can file the paperwork to make the S election, and you're going to do that with the IRS. And then you're going to register for a payroll account, because if you are being taxed as an S Corp, you also need to become an employer of yourself. Then you're going to set up your tools. So you want to have an actual bookkeeping tool. There is so much more accounting complexity with an S Corp that frankly, a spreadsheet or a shoebox full of receipts is just not going to cut it. There's a lot more accounting and bookkeeping you need to keep up with. And you'll also want to invest in payroll software. People often ask me a lot, can I just DIY my payroll? You can DIY your payroll. Do you want to DIY your payroll? It's not really an issue of a can. It's like, is it should you? It's not a can, it's a should. So payroll is extremely complicated. I used to write many articles about how to run payroll manually. If you love tax tables and sending in paperwork every quarter, then maybe you'll love DIYing your payroll. But payroll does require that you file quarterly payroll tax returns. It also requires that you withhold different amount of money and send that in on a regular basis to different agencies, both federal and state. It requires you to do a lot of math. Payroll software is very affordable, and it is so worth it to ensure that you're doing all of this stuff correctly, because it automates all that, and then also that you're not spending your time on it. Then you're going to set up your money flows. So you want to make sure that you have a business bank account and a business credit card all tied to the LLC. So you want it to be under the LLC's name and under the EIN to help protect your liability protection. And then, of course, you're going to change any expenses and customers over so everything is flowing into that LLC. So in terms of ongoing operations, my mouse is so sticky today. You're going to need to file. So you'll need to file that S Corp business tax return, and you still will need to file your personal tax return on a federal and state level. So now you have 4 tax returns that you're doing. You'll also need to do those payroll returns, which I just talked about. So the payroll returns are very easy when you have payroll software. You're going to need to maintain the entity. So that looks like filing state paperwork, and then any minutes or notes that you may be required to maintain. And then you need to keep up with your bookkeeping and tax obligations. So that is looking at maintaining your books monthly. Again, more complexity. We want to keep up with it more often. And you will need to pay estimated taxes quarterly, federally, and to the state. So S Corp owners still need to pay quarterly estimated taxes on their expected S Corp income. All right, so we are going to run another poll. And my question for you is, are you ready to start an S Corp? So Sarah's going to pop up another poll and let us know. Are you ready? You can say, yes, I'm in, not just yet, and I'm still not sure. Now I'm going to take a sip of tea because I have been talking for a long time. All right, let's close out this poll and see what the people have to say. Oops, I'm all over the place. There we go. 18% of you say, yes, I'm in. 58% say not just yet. And 24% say, I'm still not sure. Well, I have resources for all of you. Well, first of all, for those of you who say not just yet, that's okay. Really, the intention of this webinar is not to get every single person who joins to sign up for an S Corp. The intention is for you to have the information you need to make an intentional decision about your business. So if you walk away today being like, this is not right for me right now, but I do want to revisit this in the future, that is success to me, because you are going to be making intentional decisions about your business instead of just maintaining a tax structure that doesn't work because you don't have the information you need. For those of you who are in, or for those of you who are not ready yet, I'm going to share a resource, or who are not sure, I'm going to share a resource. But first, I wanted to give you a little bit of information about how Collective can help with your S Corp. So this is what starting an S Corp is like without Collective. Now, this looks a little bit like the one I shared earlier, except this one is specific to S Corps. So we have things like the S Corp setup, that reasonable compensation, the S Corp tax return, right? The accountable plan. And this is what your finances look like with Collective, especially when it comes to S Corps. So at Collective, we specialize in S Corps. I kind of think of us, it's a little cheesy to say like, we're the S Corp people, but we are the S Corp people. We're experts in S Corps. And not only are we experts in S Corps, we're experts in S Corps for solopreneurs. So we've really built a model where we want to serve the self-employed community and the solopreneur community. And so we understand S Corps on the level of how they apply to self-employed people. Because let's be real, when you're self-employed, and especially when you're a solopreneur, what works for you is not the same thing that works with somebody with 20 employees. It's very, very different financial advice. So we specialize in S Corps for self-employed folks. And we work with sole proprietors. So if you don't have your S Corp set up yet, we will help you, or your LLC set up, we can help you with that. We work with single member LLCs. So if you already have an LLC and you're like, this is great, I want to do this, we'll help you get that set up as an S Corp tax status. We work with LLCs who are already filing as S Corp. So maybe somebody told you to do an S Corp tax election, you did it, and now you're like watching this webinar and like, whoa, there's a lot of stuff that I'm not doing. We can help you. And we exclusively work with folks who earn $60,000 or more in self-employed profits. So the reason for that, as we mentioned, is that this is not an Oprah situation where it's like you get an S Corp and you get an S Corp and everyone gets an S Corp. It really has to be the right fit for your business. And we want to ensure that you're actually going to benefit from this tax structure. So let's talk a bit more about what Collective does. I always like to think of it as one login to run your business, because the model that we are building is a single platform to run your financial back office out of. And that's going to start with LLC and S Corp formation. So we will form your LLC, we will file that S Corp tax election, we'll obtain that EIN for you, and we will do the operating agreement as well. So everything starts rooted in that formation. Then we move on to bookkeeping and accounting. So at Collective, every Collective membership includes monthly bookkeeping. It also includes S Corp specific accounting. We also have tools inside of our dashboard where you can easily track, record, and submit your accountable plan expenses and see like the calculation in real time of, all right, this is how much you got to pay yourself from your S Corp to account for the accountable plan. And then our dashboard also has a really cool accounting and bookkeeping hub where you can access your financial reports. You can look at your income by client. You can also just see like snapshots of your profit and loss and your cash flow. So there's monthly financial reports and insights as well, all within one platform. So all of this is happening inside of a single platform. Like I said, one login to run your business. We also do payroll. So inside of our platform, you can run payroll for yourself, as well as pay your contractors and file 1099s. And of course, that also means that we are taking care of the payroll tax filings, as well as giving you guidance on the S Corp reasonable compensation. And then, of course, taxes. So Collective, we take care of your S Corp tax return for federal and state. And again, this is all happening inside of your platform. So while we have a team of like human beings doing your taxes, where you submit your information and how you track your progress is all under this one login. And then we have our estimated tax calculations and reminders. So every quarter, you're going to receive a calculation from us about how much you need to pay the federal or state government based on your S Corp income. So because we're handling the accounting, that enables us to be able to give you these calculations to help you keep on track with your tax bill. And then finally, compliance and support. So when you are an LLC, we mentioned this earlier, there are certain state fees you may need to pay. There's certain filing requirements you may have. We will send you emails and reminders about that in your dashboard. So we have a little example here. And then also with Collective, you have a support team you can message anytime. So every Collective member receives what's called a member relationship manager, which is their point of contact for their account. So if you have a question about a tax deduction, or maybe you get some kind of like strange notice from the IRS in the mail and you're like, what is this? You can email that person and say, hey, Victoria, I got this in the mail. What is this? And they will respond. And again, these are real people. So one of the things that's really exciting about Collective is that I always think of us as people-powered technology. We have the tech, we have software, we have a platform to really give you visibility into your finances, to also give you visibility into like running, doing daily tasks like running your payroll. But there's a team of real human experts who are actually doing the things that an expert needs to do, like bookkeeping, accounting, taxes, your business formation, so on and so forth. Now, before I get into pricing and what's next, I do want to mention something because I kind of think of this as something Collective does. So if you are an existing LLC and you're like, I want to be an S Corp for all of 2024, Collective has a very special process where we can backdate your S Corp tax election to January 1st. So if you're an existing LLC, you could still get an entire year of tax savings for your S Corp. And this is not an additional fee. This is not an additional cost. This is just something that we do for our members who are joining a little bit later in the year. Because currently, if you're an existing LLC, currently, if you filed the paperwork yourself, you wouldn't be able to go all the way back to January 1st. You'd only be able to go back to like January 15th, and that then will cause some accounting headaches for you. But this is something that Collective offers. This is a special process that we do. So just putting that out there, if you are an LLC, we can backdate your S Corp election to January 1st. Okay, so collective costs. $349 a month, and that includes everything that I just mentioned, and there are no additional fees for like tax filing, for the backdating, for the payroll, the monthly bookkeeping. It's all inclusive in the $349. We do have a one-time onboarding fee of $199 a month, but I'm going to share a very special offer that expires soon, where you can have that waived. So what's next? Sarah's going to put a link in the chat, but we want to invite those of you who are a yes on being an S Corp, or who are not quite sure and you're like, I kind of need to talk to somebody that is not like a webinar about my unique situation, to schedule a free call with one of our tax advisors. So this call is free. It's a consultation with one of our tax advisors to really talk through if the S Corp makes sense for you, and a little bit more about Collective and it makes sense for you. Now, we do have a special promotion running right now until the 31st, which is 1 month free and no onboarding fee. So that's about a $550 savings that we're offering through March 31st. So I highly recommend, if you are considering Collective, to get on a call now. You can schedule that. Sarah, again, is going to put that link in the chat, because what will happen is, even if you, let's say that you can't you get on a call now, but you're still trying to decide, sometimes they'll extend the promo. So sometimes that will happen. So just get on a call now, talk to your tax advisor, see if it's a good fit, and definitely get in on this promo, because we don't run this very often. We only run this one twice a year. So 1 month free and no onboarding. The code is Spring Savings. And it's about a $550 value. Okay, I am going to go to the Q&A and start doing the Q&A. And I see someone's asking about the questions not being answered, and the answer is yes. They're getting answered now at the end. I don't do them during, because if I did, I feel like this webinar would be like 3 hours long, because we get sidetracked. Also, usually the Q&A is about an hour. So, okay, I'm going to answer the Collective specific questions first. I see that there's only 3 of them, so it should be pretty quick. And then I'll go all the way back up to the top of the Q&A box and answer them in order. Anonymous says, does Collective help LLCs or only S Corp? So we only will support LLCs who want to file with the S Corp tax election. So if you are an LLC and you're like, I want to be an S Corp, we can work with you. If you are an LLC and you're like, I don't want to do the S Corp thing, we won't be able to support you. Anonymous says, I'm behind a year on taxes. Does Collective help with back taxes? So Collective does not help with back taxes. However, we have a partnership that's only available to our members that can help with your back taxes. And there's a really nice like 20% discount that our members have available to them for getting their back taxes caught up. So if you were a Collective member, we would be able to offer a resource that would help you with that, and then also save you some money. Anonymous, does Collective's tax professionals give advice, guidance for maximizing deductions or finding overlooked deductions? Well, so here's the thing on like finding and maximizing deductions. Because we're doing your bookkeeping, to some degree, we are maximizing your deductions, because we know what should be written off in your books. But yes, if you wanted to have a call with your member relationship manager and be like, can we just talk about the things that I'm, buying, and see if I'm missing something or there's a deduction that I haven't thought about, you could certainly do that. I should mention, like, our member relationship managers have like seriously impressive backgrounds. Some of them are CPAs, some of them are enrolled agents, like they're like financial professionals. So that's the type of person you're talking to. It's not like a customer support rep. It's somebody who actually has like a very robust financial background. So you could have like a call with somebody and go through that. Okay, so I'm going to go back up to the top and answer these questions. So I see a couple questions from Laura and Rich about the recording. Yes, so the recording will be available. We send it out within 24 hours of the webinar. So just keep an eye on your inbox. We do not send out the slides, but you will have the recording. You can watch that as many times as you need. Anonymous asks, can a self-employed receive a W-2 or payroll check? You can if you are filing with the S Corp tax election. Now, if you mean like, can somebody else hire me under my business as an employee? The answer is no. They would just be hiring you as an employee apart from your business. So that what comes into play there is that deductions related to the work that you're doing with that person, you wouldn't be able to take. But if you're asking if can I, being self-employed, give myself a paycheck, you can if you are filing as with the S Corp tax selection, or if you're filing with a C Corp tax status. Rich, if our regular job maxes out payroll taxes, would a side gig LLC assess an additional taxes? No, this is a great question, Rich. So Rich is asking about something that is called the Social Security wage cap, where basically you only pay Social Security taxes up to a certain amount of your income, which is, I think, 163 this year. It's somewhere in the 160 range. It's somewhere in that range. So after you earn $160,000 or 100, whatever the cap is, after you earn that, you no longer need to pay the Social Security portion of the self-employment tax. So let me go back, because I think, so my mouse is being really bratty. Sorry, friends. Okay, so this portion, this 12.4, you wouldn't pay that. You still will pay the Medicare though. The Medicare sticks around. So, and Sarah, maybe you can put the article on the Social Security wage base in the chat if you can find it. But essentially, the LLC would not assess additional taxes because that is on a per individual basis, not like a per like type of job that you have. So sometimes for certain people, the S Corp, if you're a really high earner in a W-2 job, the S Corp may not have as much tax savings benefits. We've had that happen before where people will actually still join collective because they're really excited about like the retirement side of the S Corp or other things, but they may not receive as much tax savings. Jolanta, what does the annual report need to include? So this is a hard question for me to answer because the annual report is based on, every state's different. But generally speaking, what the state wants to know is if the address and the owners are still the same of the business. So again, I can't say specifically because every state has different requirements, and some of the states, they're annual, some of them they're every 2 years, some of them they're every 3 years, some don't even require one. So it's not like everything is standard across the board, but that's generally the types of information that they're asking for. Jolanta, what if I'm just starting a business? How can I pay myself if I did not make enough yet? Do you do a small amount, or I'm only start paying myself in S Corp after I start making more money? So if you have just started a business, you can take what's called an owner draw out of your business to pay yourself. Basically, that's just a way of transferring money from your business to your personal account as your owner pay. So it's different than the way that you get paid from an S Corp, because the way you get paid from an S Corp is through payroll. So you're paying payroll taxes on that. When you take an owner draw, there's no like additional tax that is assessed on that draw, because all of the profits are getting passed through to you, and you will be paying tax on that at the end of the year. So it's a little bit different than corporate dividends, where the owners have to pay taxes on any dividends they receive. In an owner draw, you just take the money out of your business. You can use it personally, and then at the end of the year, you're going to be taxed on the business profits of that year. So you can certainly start paying yourself. And this is a little off topic, but what I will say is I encourage you all if you've started a business and that you haven't quite, like, you've been wanting to pay yourself, but you're like scared to do it, scared to take a draw, even just getting into the practice of taking money out of your business personally can be really healthy, from a mindset perspective, because what can often happen, and I've seen this when I was a consultant, is that people won't pay themselves from the business because they're like, oh, I want to reinvest, I want to reinvest. But this goes on for years and years. And they get to this point where their business has sort of been built on not taking care of the owner itself. And it's really hard for them to transition off of that. So even if your business is earning very little money and all you can pay yourself is $40 a month, try to build the habit of paying yourself. Laura, can you have solo employer IRA and your regular W-2 401k at the same time? Solo, I think you're talking about a solo employer IRA, and oh, okay, you're asking if you can have the solo 401k and a W-2 401k at the same time. Got it. You can, but you still have individual contribution limits. So you have to remember with like retirement accounts, the contribution limits are not per account, they're per individual. So you can have different retirement accounts, but you know, you're gonna have to, there's only a certain amount up that as an individual you can contribute. Sergina, so the S Corp tax law and benefits, does it apply to C Corp? Okay, so great question. I knew C Corps were going to come up. I saw Jolanta at the end also asked about C Corps. So let's come back to our core concepts. A corporation is a type of legal structure. A C Corp is a type of tax status. So a C Corp is like an S Corp. It is a tax status for a legal structure. So a corporation by default is taxed as a C Corp. An LLC by default is taxed as a sole proprietor. Actually, there's no legal structure that by default is taxed as an S Corp. So can you elect to have your corporation, which is over here in this bucket of legal structures, taxed as an S Corp? Yes, you can. But we're talking about a corporation in the legal structure, not a C Corp, because a C Corp and an S Corp are the same thing in the sense that they're tax elections. So you can only have one. You can't be taxed as an S Corp and as a C Corp. But you can have a legal structure, that foundation of our house, that is a corporation, and elect to be taxed as the S Corp. Donna, where can we find a list of allowable reimbursement expenses? We have a blog article about accountable plans. Sarah, if you can find that and put that in the chat, that would be great. That has a list of accountable plan expenses. Basically, they are expenses related to like home office. So similar to the way that you take the home office deduction, it's like you measure your space. Your space is, let's say, 20%. Your business use space is 20%, and then you write off 20% of things like your rent, your utilities, security system, so on and so forth. And then there are also options for personal use of your vehicle. So you can basically have the S Corp reimburse you for like mileage driven, personal cell phone, and home office. So we do have an article about that I see Sarah just posted in the chat for us. So that article will go like much deeper into this concept and a list of those expenses. Jolanta, so I can do taxes for LLC and decide anytime to be taxed as an S Corp. Yes, that is correct. Do I have to pay an attorney, accountant, or some other professional to switch the structure, or only do it somewhere on the IRS or online? So that's sort of up to you if you want to pay someone to help you with it or not. You can file the paperwork yourself. The form is Form 2553, which is basically the form that you file to ask the IRS to change the tax treatment of your LLC. So you can certainly do it yourself. It's just if you feel comfortable doing it yourself, or you can pay an attorney, an accountant, or like another service. You can also use a service that's like one of those like entity filing services, or you can come to Collective and we'll do it for you. So you have options. But it's not a requirement that you go through a third party. You certainly can do it on your own. Raphael, do you also pay the self-employment tax on the pass-through profits? Not clear on how I'm paying 7.5 from the LLC S Corp and then 7.5 taxes as savings. So you do not pay that 15.3.3, which Raphael, you're calling. I'm trying to find my slide. You are not paying that 15.3 or what you're calling self-employment tax on the pass-through profits. You're only, when you're in LLC taxes and S Corp, you're only paying that on the owner wage. So that is why it's a benefit, because when you are a sole proprietor, you pay it on all the profits. You pay it on the whole shebang. The whole shebang, you're paying that. But as the S Corp, you're only paying it on the wages that you earn from your business. That's where the tax savings is coming in. Even though you still have to pay some taxes, right? We still have to pay some of this 15.3%. It's assessed on less money. So there's less of money that's subject to it. So that's where the tax savings comes in. Jolanta, would you please mention what is a C Corp? So I think I already talked about this, but just to recap, a C Corp is also a tax election. So a corporation is a legal structure. A corporation by default is taxed as a C Corp. But a C Corp is a tax election. So you can also elect to have your LLC taxed as a C Corp. That's another option that is available. It's not something that generally solopreneurs do. It just doesn't, it's not really like meant for that. But that is what a C Corp is. We also have an article. Sarah, can you post the article that is LLC, S Corp versus C Corp? We have an article, maybe YouTube video. We could post one of those in the chat. That would be great, because I think that goes deeper into the differences of C Corp, S Corp, corporation, so on and so forth. And that will help answer your questions in more depth. Anonymous, we want to be an S Corp, but right now we're just starting out, so it makes sense to take S Corp election next year. I love that you're using words like election. It makes me happy. Would you accept this as an LLC with the intent of growing to S Corp next year? No. But when you are ready next year, come to us and we will accept you then. So we only work with folks who are filing the S Corp tax election, because we really believe in, like, at this point in where we're at as a company, staying hyper focused on what we know we can do really, really well. And what we can do really, really well through the way we've built our product and the way that we've trained our team is to work with S Corps. That isn't to say that there isn't a future state where maybe Collective could, take other types of folks. But where we are right now, we are staying focused because we want to be able to serve our members to the best of our abilities. Anonymous, I'm not an LLC yet. Does Collective help set this up, and is there an additional cost? So Collective does help you set up your LLC. So if you're a sole proprietor and you're like, oh, I need to be an LLC with an S Corp tax election, we can set up your LLC for you. There's no additional cost. So that $349 that you see, that's like all inclusive. There is that $199 onboarding fee, but as I remind you all, that is waived until the 31st. So you still have time to get on a call with a tax advisor and benefit from that fee waiver, and then there would be no fee, really. Are we going to receive a replay? Yes, you will. Probably better to speak with someone about this. Okay, Sarah, I'll read it through and I'll tell you if it's better or not. So I am starting as a 1099 on April 1st with the goal of definitely making over 60K over the spring and continue with this intake over the next year plus. But I don't have extra cash yet to make an LLC, let alone an S Corp. How will starting mid-April, early May, how long can I wait to make the S Corp election? Okay, so I can answer this question for you. So I'm trying to gather the best stepwise way to explain this. So when you start your LLC, so let's say you start your LLC on May 15th. Let's just make life easy for me. May 15th. Well, if you start your LLC on May 15th, you have up to 75 days, according to the IRS, to make your S Corp election to go back to the date of your LLC formation. So if you start your LLC on May 15th, then you have until the end of July, basically, because 75 days is 2 months and 15 days. So you could make your S Corp election June 30th, and the IRS will like basically backdate it to the date of your LLC formation. You cannot backdate S Corp tax status before your LLC was formed. So the situation that you're sort of in right now is you have to decide if you're starting April 1st, is it worth it to start your LLC on, April 1st, so that you can potentially like backdate back to the first date of formation when you have self-employed income. The other option is if you're like, no, I can't do it. I don't have any money to do that. Like, it's not happening. What will happen in that case is that for April 1st through May 15th, you're going to be taxed as a sole proprietorship, and you will have to file taxes for that 6 weeks period as a sole proprietorship. May 15th onward, you're going to be taxed as an S Corp. And this is in my hypothetical. I don't know your real dates. I'm just making up a date so it's easy to explain. May 15th onward, you're going to be taxed as an S Corp. And then you'll have a whole other way that your taxes will be being done. So it is a little bit complicated because you're being taxed in 2 different ways through your business, because you basically have split your tax status in, you have 2 tax statuses in 1 tax year. So that's kind of what would happen. The thing is like you can still like save a pretty hefty amount of money if you elect in May. So I think there's still, well, I don't know how much money you're earning, right? But there could still be like plenty of benefit to kind of deal with the pain of having 2 tax statuses throughout the year. When people are asking this type of question in November, it's sort of like just wait till January 1st, because the tax benefits are just not really going to be there. But really, I would say up till June 30th, there's plenty of like great benefit that you can still derive from an S Corp. Because if we think about our example here, which I didn't even realize was still on the screen until now, this example is $15,000 in savings. If you did a mid-year election, that's $7,500 in savings. I mean, that's still a lot of money, right? It's not like it's nothing. It's just not the full year. So there still can be benefit to switching, even if you have to do it a little bit later, and you just sort of deal with the pain of having 2 tax statuses in the year. We have an article, Sarah, on mid-year elections and switching, like what happens when you switch your S Corp into an S Corp mid-year. Maybe we can post that, because that also goes more in depth about how the taxes will work. Tishala, do I need to change my business to S Corp, or is that just a filing status? So I think this question is, I already have an LLC. Do I need to change everything over? So no, you don't need to start a new LLC. You don't need to like have a brand new LLC from scratch or anything like that. You can convert your existing LLC's tax structure to the S Corp. Joletta, so what's the difference between C Corp and S Corp structure there? We have a video in the chat. I'm going to let the video do it, because the video is like so good. It's 3 minutes. It's great information, and it's going to explain it better than I could. I mean, I was involved in the production of it, so I know it's really good, and the answer is going to be useful for you, but it's going to be a better experience to get your answer through the video than through me. Courtney, where do partnerships fall in the range of business structures and tax elections? Great question. I love these. Your questions today are so cool. Your questions are great. A partnership is a business structure, and it's also a way. It's also a tax structure. So when you have a partnership, you can have 2 people who own a business without having an LLC. It's kind of like, I always think of like partnerships and sole proprietorships as like siblings, and then LLC, right? Because they're basically, you can have a partnership and an LLC or a sole proprietorship. And then if you have a multi-member LLC, so if you have an LLC that is owned by multiple people, the default tax treatment for that type of LLC is a partnership tax treatment. That's why I think of sole proprietorships and partnerships as siblings, because if you have a single member LLC, the default tax treatment is sole proprietor. If you have a multi-member LLC, the default tax treatment is a partnership. But essentially, with a partnership, this tax structure is pretty similar. The only difference here, when you have a partnership, let's see if I can do this cool annotation thing. I've never done it before live, so we'll see. Is that this profit and loss gets split to 2 owner tax returns. So you're going to split, like if you have 2 partners, right? And it's like 50% ownership here, 50% ownership here, you are going to split the profit or loss between the 2 partners. So if this business, a partnership, is earning $100,000, then 50,000 goes to partner A, 50,000 goes to partner B, and then the rest of this is all applies to both partners. So partner A will still have to pay self-employment tax and income tax, and partner B will still have to pay self-employment tax and income tax on that 50. Clear all my drawings. Oh my gosh, that's so cool. I've never done that before. Okay, so if I join now, does Collective help with 2023 filings? I answered this already, but the answer is no. But we do have a resource and a member-only discount that we offer. And the member discount's good. It's like 20%. That will help you with those filings. Great. Now I'm like stuck on annotate. Okay. Anonymous, when we work with you, you will do our S Corp taxes? Yes. Are you helping us with individual taxes too, or do we need an accountant helping us with our personal taxes? So we only focus on the business taxes. What we give you is a packet that you take to your tax preparer or to TurboTax, if you're going to do it yourself, that has all the relevant information. Because when you have an S Corp and you do that business tax return, there are forms generated that the owners will need to have in order to report their S Corp pass-through profits on their personal tax return. So we basically give you what we call like your personal tax return packet. That is everything you need to just hand off to an accountant or a tax preparer, like an enrolled agent, or if you are doing your own individual taxes yourself, like TurboTax. Rich, the tax benefit of a solo S Corp seems wrong. You and the company are paying those payroll taxes. Yes, but only on the wage that you are earning. You are not paying it on all the profits. So typically what happens is that you are paying these taxes, this social pay. So first of all, it's very confusing because when you're a sole proprietor, a single member LLC, they're called self-employment tax. When you're an S Corp, it's called payroll tax, even though it's the same thing. So I'm going to simplify it and call it Social Security and Medicare taxes, the 15.3%. When you are a sole proprietor, single member LLC, you only pay that 15.3% on all of your business profits via self-employment tax. So in this example, all of this money that's profit, this $160,000 that passes through to you, is subject to 15.3%. When you are an S Corp, you only pay Social Security and Medicare taxes on your owner employee wage. So yes, you are still paying Social Security and Medicare taxes. That is absolutely true, but only on the owner wage. That, in this case, that's $60,000. Now, if you paid your owner wage out to be $160,000 in profit, in this example, you're right. You would not have any S Corp savings. But nobody's going to do that because that defeats the whole point of having an S Corp. So it's about the amount of money that is legally subject to Social Security and Medicare taxes. Without the S Corp tax election, when you're taxed as a sole proprietor, which is the default tax treatment for a single member LLC, you have all of your business pass-through profit, $160,000 in this example, is subject to that 15.3%. With the S Corp tax election, the money that is subject to 15.3% is your owner's salary. So it's different. The pass-through business profit isn't subject to any of that. So in this case, this $100,000 that's passing through to the owner's tax return is not subject to 15.3% in the same way that it is here. That's where the tax savings benefit comes in. Sarah, if you are a 1099, do you hire your S Corp or yourself? How does this work if you're a medical provider, if they hire you as an S Corp? Because they need your specific license, etc., not the business license. Okay. So Sarah, there's a little bit of complication in this because depending on what state you're in, uh, you will that what type of entity you can form may solve this. So there in certain states, medical providers can't form LLCs. They have to form other types of entities, which basically have different liability laws and rules, which kind of ties into like your specific license. Um, so the idea here is like your license becomes part of the business, and then the business, like, how do I explain this? The business liability protection is different than an LLC. So one thing, Sarah, is I don't know what type of medical provider you are, but you probably need to check with your state licensing board, with whatever type of license, medical license you have, on what you can actually form in your state. Because there are other types. There's something called a professional corporation. There's something called a professional LLC. There are other types of things like limited liability partnerships if you're doing like group practice. There's all these different types of business structures that have different laws about who can form them, and you may not even be able to form an LLC. I don't know, because it's state by state, license by license. So this is why the best advice I can give you is to check with your state licensing board about what entities in your state with your license you can actually form. Now, in terms of, do you hire the S Corp or yourself, you want them to hire the entity itself, right? So you want them to hire the entity and not you, because by hiring the entity, one, the entity is getting paid. And remember, you as the individual, like you as a sole proprietor cannot be taxed as an S Corp, which means if they're just hiring you individually, you're going to pay all of that extra self-employment tax. They're hiring the entity and the entity is electing to S Corp tax treatment, then you have that tax savings benefit. And if they're hiring the entity, depending on what entity that you are able to form, then there's some additional layer of liability protection. Sarah, we have an article on, I think it's like PLLC, or maybe it's the YouTube video on like PLLC versus professional corp that maybe we can put into the chat that goes a little bit deeper into some of these nuances. Destiny, is it true you should only become an S Corp when making 50K plus in California? So Destiny, the threshold that we use is $60,000 and above. It does, in California, it's still 60K. The only state where that could be slightly different is New York, because New York City has a few additional taxes because they do not make things easy either, where sometimes it's more beneficial if you're earning a bit more money. But the threshold we use is $60,000. And for California, we don't have like a different guideline. Jolanta, last question. Is the tax deduction benefit to have my husband and I owners of the LLC or just one? We filed jointly. My husband has W-2 and I am self-employed. So this is a hard question to answer because I don't know enough about like what your husband would be doing in the business and if it would really, you know, how much your husband is already earning through his W-2 job, right? There's a little bit of nuance here that I just simply can't answer. But Sarah, we have a, Sarah, if you could put the article on, should I add my spouse to my LLC into the chat? We actually have an article that addresses some of the common questions that have to do with like adding your spouse to your LLC that you could take a look at that I think would help just kind of like help you think through. Yeah, this is great, Sarah. Thank you for adding LLC versus professional corp. And then if we could add, should I add my spouse to my LLC? Then I think that would help you kind of think through this a bit more in terms of, because I can't really answer this without knowing your specific situation, but it'll just give you some things to think about. So yes. All right. Well, that is it, everybody. I'm not going to say goodbye until I know that, there we go. There's that article I was mentioning. I just want to make sure we got that one in the chat before we close everything down, because then it's like, uh-oh. Thank you all so much for joining us today. I hope you all learned something. We've put a lot of additional resources into the chat, so hopefully you can also get your questions answered, anything else that came up for you. And of course, we always hope that we will see each and every one of you as a collective member when the time is right. Thank you all.